Let's get it, y'all. About to research these stocks, man. About to get to it. Set up for you guys. Y'all ready? Y'all ready, man? Let's get to it. I'm about to come out with these picks for my group, man. Y'all ready? Y'all ready to get some money with me? Put y'all on real game, man. Y'all ready? Sket it. Alright, so the first one is going to be the first one we like to, hold on, give me one moment real quick. Let me open up a tab real quick. Notes here. This is call outs. Alright, cool. Alright, bet. So the first one, guys, what we're gonna do. Is this setup cool, y'all? I just thought of some shit. I was just like, I need to figure out a way for you guys to be able to see my screen and see everything. It's not the best, but I think it's, it'll work. You guys can see stuff, see everything. He said, hey, do you have a Telegram? No, I don't have a Telegram. Oh, that's Aaliyah Alexis. No, I don't have a Telegram. I have a Circle community. It's the link in my bio. So it's not a Discord. It's not a Telegram or anything like that. It's called Circle Communities. And that's where I do my call out signals, member communication, our live meetings, all that type of stuff in the group. So if you guys are interested in that, just DM me the word invest, or it's the link in my bio. You guys will get full access to that. Okay. So let's cover these stocks, man. I'm going over these stocks. Every month I do long-term picks for my group, for us to like invest in and take interest in. So that's what I'm about to be breaking down. If you guys are interested, I'm literally, you guys are going to be able to see me in real time, like the process of me breaking down stocks. So, just stay on the live so you guys can see me do this. So if you're somebody that like, you don't know what stocks to buy, how to research stocks, things of that nature, obviously I'll teach it in my program. But for right now, for this live, I'm giving this free sauce to you guys. All right. So actually how to break down a company, what should you be looking at, things of that nature. All right. So that's what we're about to go over right now. Let me put my phone on the charger. So this thing don't end up dying on me. Y'all can hear me okay, or do I need to put on my mic? We all good? Somebody let me know. TJ Stacks Up, what up, my dog? How you feeling, bro? All right, bro, I'm giving you free game, bro. Don't rush me, bro. If if you really wanted to get to the bag, you would have been already signed up for the community mentorship already. If you was that in a rush to get to it, so don't come on here. I'm giving you free game, act like you just so in a rush to learn some shit. When really, if you really wanted to learn and get to this shit, you'd already been signed up for the program. So chill out, my dog. How you gonna try to rush a nigga that's giving you free game? If you really wanted to learn, really wanted the information, you would have been paid for the information already. You would have been paid your $60 entry fee and got to it. Feel me? You not that in a rush to learn, bro. Real life. Alright. So the first one, guys, we have XLF. Somebody pointed this out yesterday in the group. Okay, this is State Street's financial sector ETF, man. What I like about this is when you scroll up, okay, and these are the charts. All right, so this is what I like to do first. What I like to do is pretty much I want to just go see where the stock is trading at, technical wise, and I go look at like certain fundamentals and things of that nature. But I want to see, okay, just first when you guys pull up a chart, you want to look and see where is the stock either trading up all time or down all time. Okay, so clearly right now you can see that XLF is up all time. So this is a financial sector ETF. Okay, and this thing is up all time, correct? So and let me know y'all can see my screen. Cool, it look cool on my end, but just let me know. We look decent. I'm liking this setup. We might go with this for now on when we do like certain things, unless I need to do something on my bigger screen. But I think like for right now, for the cool, just covering stuff, I think this is good for us. Even for YouTube, honestly, this ain't that bad. The lighting is a little off. I can get some lighting and put that through. But matter of fact, hold on, y'all. Let me actually get that for y'all. Do have access to light here, so if I just hook this up like this, boom, there we go. I'll just go like that. You guys can see that a lot better. All right. It's not too bad. So we all good. We straight, y'all can see. We all good. It look like we good on my end. Alright, cool. So we gonna thug it out like this. Alright, bet. So I'm looking to see where XLF is. It's up all time. That's what I like. Perfect. So I take my price range bar and I just want to see from IPO how much is this stock up, or this ETF. It's up 187% all time. Perfect. Okay, so it's up 180% all time. Cool. I like to see that, and I like to see that this thing's in a full uptrend. Now, obviously, within the full uptrend, you're gonna have those points where you have these down draws, these big down draws. Okay, so one right there, one right there, one right there, a recently one, right? But if you look at the full picture, look at the main picture, all time is going up. Okay, so that's letting you know that pretty much you can trust the stock. You can trust this investment, all right? Because it's been going up since it IPO'd, which is 1999. So basically since 2000, for 26 years, this thing, it did nothing but go up. But within those specific moments in time, yes, it had pullbacks and drawdowns. All right, makes sense? So that's what I like to see on the chart. Cool, a nice little uptrend. Now what I want to do is stock analysis. I go to one of my main websites in which I teach in my program how to navigate this, stockanalysis.com. We go right here. Okay. And then what I want to do, Type in that stock, XLF, that ETF, boom. And then what I need to do, actually this is the wrong one, XLF. Why is it not popping up? XLF, hold on. You might have to go to Yahoo Finance. There we go. All right, so let's see if we can get it to pull up XLF. Here we go. Now I want to look at the holders. When you guys are looking at ETFs, make sure you're looking at what holders are in that ETF. You don't want to buy an ETF and you don't know what's actually running the ETF. Okay, so remember that ETFs are just baskets. ETFs are just literally one full fund that has multiple stocks in it. Does that make sense? So it's a fund that has multiple stocks in it. All right. So what you need to understand, what stocks are in that ETF, because it's going to let you know what stocks are controlling the way that ETF moves. Okay. Because it's all based off percentages. All right. So I know this is going to tell me my, typically you would be able to use stockanalysis.com, but for some reason it wasn't, the ticker symbol is not popping up. So I had to go to Yahoo Finance and type it in. Yahoo Finance just gives me the top 10 holdings or the top holdings. You can also probably go to like a few different other websites too as well to get the full holdings list. Obviously, you can go to the fund's website directly itself. It'll tell you that. But you really just need to know the top ones, like the top 10, top 20 ones that run the ETF. All right, so this is a financial sector ETF. The top 10 holdings that they have is Berkshire Hathaway, JP Morgan, Visa, MasterCard, Bank of America, Goldman Sachs, Wells Fargo, Citigroup, Morgan Stanley, and American Express. So that means, okay, that these are the top 10 holdings of this ETF, okay? And it's a financial services ETF, okay? And the main movers that moves this ETF is those top holdings. Does that make sense? Okay? So Berkshire Hathaway, JP Morgan and Chase. Look, Berkshire Hathaway got 13%. JP Morgan got 11%. Visa, 7%. MasterCard, 5%. You feel me? That makes sense? So, cool. I know what stocks are the top holders in this ETF. Okay, so after I figure out, and this is an ETF, so you don't got to do a lot of real digging into an ETF. It's really simple. This is pretty much all you have to do as far as when it comes to an ETF, not individual stock. With individual stock, you got to do a lot more stuff. When it comes to ETF, it's pretty much a simple breakdown. I like this ETF because it's only $52 a share. That's really good. ETFs are typically going to go in your conservative portfolio. Okay. All we have to do now is figure out a good buying point and good buying entries for this ETF. So what I like to see is it's at 52-week highs, but we can still grab it because with an ETF, we're not really tripping on it being at 52-week highs because you got to think. Look what it's been doing for the last 26 years. This thing is only going to continue to go up, most likely, right? Very high chance probability. Obviously, it's going to take those downturns and those dips, but you will just continue to buy in. All right. So what I would say right now, as far as XLF, good ETF, does this thing also pay a dividend? Let's see that real quick. Let's see if this is a dividend. Let's see if they give out dividends. What I'm going to do is controlled by State Street. Dividend treatment distributions. They might pay a dividend. I'm not seeing nothing on it right now. But you can also use NASDAQ.com too to figure out that too as well. All right, we're not gonna spend too much time on this. Let's write this down. So we gotta go right here. Hold on. Exit that. XLF. I like to do starter position, which is going to be your starter position. Starter position anywhere from where it's currently at now, which is about, we'll say 53 through 47. Starter position. It's really good. 47 was the last support of which it had, which it just bounced off from a few weeks ago of 47. You guys see that right there? Let me take this away. You see how this was the last point at which it bounced from highs. So if it tanked from highs, it hit a bottom here at 47 and change, and then it popped. So good starter position would be anywhere from this 53 to the last structured support. Make sense? That's kind of how I would play this. All right, so starter position anywhere from 53 to 47. Okay. LTB means load the boat prices. Load the boat prices. Anywhere we could just say this right here. Load the boat prices, we said 47. So good load to boat prices would be I would say 42. Even though that'd be a really crazy dramatic dip, but I think 42 would be good. Anywhere between like 42, really like 45 through 40 and below. Okay, and I'm gonna explain to you guys why I do this, the way I do it. So 45, the gold price is 45, 40 and below. There's gonna be risk. Matter of fact, that's actually gonna be in our conservative portfolio. So starter position means, because you always want to average in your stocks. It's all about your average cost. It's all about your average price. Okay. So the lower you can get your average cost, the lower you're putting your risk and the higher your chance of your gain. So starter position, let's just say, for example, you got $1,000 that you want to put in XLF. You want to put in a full 1,000 at your starter position. Yeah, you could do that if you wanted to be just that aggressive with your investment. But typically it would be smarter for you to go in 400 right here in the range between your starter position range of 53 through, we said, 47. So $400 is going to go anywhere in between 53 through 47. Then if it goes below 47, load the bolt prices will be you loading in the rest of that $600. Or you can do it in the reverse. You can put $600 as your starter position, and then if it goes lower to your load the boat area, you put in the full 600. Or you can go super light your starter position. You can go in $200 your starter position. Once it hits your load the boat area or prices, then you can put in $800. Make sense? That way you don't have to never always wait until it got to your first entry point to be in the green. If you buy XLF at $53 and then it go down to 47 and you don't buy no more shares at 47, you didn't have to wait all the way until it come back up to 53 just to be back break even. But if you buy XLF at 53 and then it goes all the way down to 47, you buy it at 47. Now at that point your average cost isn't 53 anymore. Your average cost is probably about 50. So now by the time it reaches 50, you break even, and then by the time it reaches your first entry point of 53, you in the green. Does that make sense? Is that game or what? You guys understand how investments work? That's how this shit works. Alright? So that's why you always have your starter position and then your load the boat price. Alright? Perfect. Let's see what we got next. Oil and gas ETF. I don't really like this. I'm gonna be 1,000, especially this 189 area. I'm not too fond of this. I'm not gonna go with that. MSFT. I think MSFT is already in our long-term picks. Yep, it's already in our long-term picks. All right, cool. UPST. Bounce clean on 27. Limited. All right, let's break this company down. Okay. Cool. So this is a company that I like their chart. All right. So a lot of times, guys, what I'm doing is I'll look at the charts first. I would just see, like, I'll just discover the stock, see what it looks like on the chart. See if the chart looks good. And then from there, that's when I actually go break the company down to get some validation on whether I should invest in it or not. All right, so that's what we about to do. So right now, what I like to do a lot of times is start on Yahoo Finance, and then I'll make my way to stockanalysis.com. But you can do either. It don't matter like how you do it, really. Just making sure you look at everything. So hold on, let me grab an apple real quick. All right, I'm back. All right, smooth. So let's see what we got. So this is Iran, ticker symbol IREN. The group brought this stock to my attention. First, I need to look and see what this company does. Okay, so you guys just don't want to invest blindly. A lot of people are investing in companies that you don't even understand what the company does and what sector and industry that the company is in. So let's read about that real quick. Okay. So it says that Iran Limited operates in a vertically integrated data center business in Australia and Canada. The company owns and operates putting hardware as well as electrical infrastructure and data centers. It also mines Bitcoin, a scarce digital asset that is created. Right, we already know what Bitcoin is. The company was formerly known as Iris Energy Limited. All right, cool. So they are in the capital markets industry and financials. All right. First things first, after you got a brief summary of what the company does, now at this point, what you want to do is you want to go to financials. So these are called the fundamentals right here. So you want to be able to break down these numbers. You want to be able to understand whether a company is profitable or not. All right, so this takes the gambling out of your investments. This lets you know that whether you should touch the company or not. Remember, the technicals let you know where to buy or sell your stock, but the fundamentals of which we're going over now let you know if you should buy or sell your stock. So this lets you know whether you should touch the stock in the first place. All right. So right here, okay, this is called the income statement. This is 1 out of 3 major financial statements when it comes to a company. Number 1 is the income statement, the difference between the revenue and the income. All right. So what you're looking for here, okay, on all of your statements, this is very simple. This is the most simplest way I can break this down. What you're pretty much looking for here is either year-over-year growth or growth in the last 5 years. You're also not looking for anything bottom line that's negative. You're looking for a surplus. Or you're looking for, okay, what's the difference between the revenue and the net income, or the cost of revenue and the revenue? Does it cost the company to bring in? How much money does it cost the company to actually bring in the revenue? Things of that nature. So we're about to break that down right now. All right. So and typically what I like to do is just look at the last 4 to 6 years previous of the business, to where I can see some consistency and some growth in that company. All right. So right here, we can see that in 2021, and I'm on their annual report. So all of these numbers is annually. So in 2021, their total revenue. So let me just break this down for you guys. So remember, total revenue is how much the company made from all of its products and services all together. So when you get your job check and that motherfucker say you made $2,000, but it say your take home is $1,400. Oh shit, I done got taxed $600. They took $600 from me. That's what net is. Gross is what it said at first before they start taking out shit for Social Security, city taxes, all that type of shit. So look at it the same way when it comes to businesses. Your revenue is that top line. Bottom line is always net. Make sense? So that's what we're looking at right here. All right. Revenue, 8.4 million in 2021. 2022, 59 million. 2023, 75 million. 2024, 187 million. 2025, 501 million. Or mid 2025. Wait, hold on. Let me make sure. All right, yeah, we good. We good. And then this is trailing 12 months. All right, so trailing 12 months right now, currently, is 757 million. So off the rip, I do see that their total revenue is growing year over year. That's really good. All right. Now at the bottom, you can see at which percentage is the revenue growing year over year. At which percentage is it growing? Okay, that's very important too. We'll get to that. We'll talk about that. But so far, I'm liking what I see. Decent percentages growing too as well. So this just saying that, hey, the last 12 months, your revenue has grown 100 and basically 70% from the previous year. That makes sense? So now, cost of revenue. This is very important. Okay? Look at it like this, bro. When you get your check, you're not just getting that shit for free. What did you have to do? You had to put work in, correct? You had to put time in to get that check. And depending on how much time that you worked, that's how much money you got paid, correct? But with a business, with these companies, with these statements, when you're looking at the cost of revenue, same aspect, but you got to look at it as money. So how much money did it take them to make this type of money? Not how many hours they put in, but look at it the same way, right? So cost of revenue is how much did it cost Iran to make that $775 million? Cost of revenue is this right here. Oh, it cost them $241 million. Do that make sense? So it cost them $241 million to make $757 million. Do that make sense? Okay? Because remember, that money is not free. That shit didn't come out of thin air. These guys invest. Okay? They do shit that we supposed to be doing with our money. They understand investing. They understand that in order for me to make $757 million, I need to spend $241 million. Make sense? Now, what you're looking at the cost of revenue, typically you want to see this go down year over year, but most of the time you're not going to see that if the company is growing at a fast pace. A lot of times you're going to see those expenses columns grow as well, but it's all about the surplus. So yeah, those could continue to go up and grow, but as long as the top line and the bottom line is growing at a much bigger percentage as well. Do that make sense? So technically, you will want to see this column go down while their revenue is increasing. But like I said, most of the time you're not going to see that if the company is growing and doing what they're supposed to do. All right, it's called spend money to make money. That's why I understand why people are so cheap and don't want to invest in themselves. When it's like, bro, in order for you to grow and get to a certain level in life, you need to learn more. You need to invest in yourself more. You need to do certain things. You need to put in more work. Like, shit just not finna fall from the sky. So this is the things that stocks has taught me, guys. Me breaking this shit down. All right. So, boom. Cost of revenue went from 2.6 in 2021 to 12.7 in 2022. Then 39.4 in 2023. And then 2024, 87. So, yeah, the cost of revenue is growing too as well. But look at the difference between that and their total revenue. Every time it's a really nice surplus. So this is telling me right here in 2021, it cost these guys $2.6 million to make for $8.4 million. 2022, they did really good. It only cost them, look at this, pay attention. It only cost them $12.4 million to make $59 million. Come on now. What type of surplus is that? That's really good. It cost a nigga only $12.7 million to make basically $60 million? I'll do that all day, nigga. I'll do that every day. What the come on, gang. That little 12 I spent ain't shit. I'm making $60 million on the back end for doing that. Look at that surplus. All right? So now you're in the gross profit. Okay? Gross profit is always the difference between the cost of revenue and the total revenue. That's your gross profit. Still not net though, but it's just your gross profit. All right? With this column, again, I'm teaching you guys the simplest way to be able to identify this shit. Again, you're still looking for year-over-year growth or just growth in the last 5+ years or however long you got the data to look at. Okay? You're also looking for a nice surplus. All right? So this is telling me, this gross profit is telling me what they kept between the cost of revenue and the total revenue. Does that make sense? So in 2021, they spent $2.6 million to make $8.4 million, but out of that they kept. They surplus, the difference was $5.8 million. Do that make sense? So they're telling me right here in 2022, they made, their total revenue was $59 million. Out of that, they kept $46 million. Because remember, it cost them $12.7 to bring that in the first place. Make sense? So what we seeing is 5.8, 46.2, 36, 100.1, 342, and 515. So yes, this is growing year over year. That's what we like to see. Really strong strength. Perfect. Now, 12 months right now, this is telling me that they brought in a total of $557 million. Out of that, they kept $515 million. Make sense? From the gross profit. So far, so good. That is what you want to see so far. All right. Now, obviously, right? You're going to have expenses. Okay? Obviously, you're going to have expenses. Okay? So, these expenses are things that you use to keep your business running. Okay? So operating expenses from the gross profit. So you take the gross profit, okay? And then you subtract that by the operating expenses. What does it cost for this business to run as a whole? That's what you're looking at. All right? That's what you want to be able to identify. Okay? So these columns here, just break it down for you, but you're just looking at for right here. Total operating expenses. Okay? You're also looking for this number to decrease as well, okay? Because if you can see a company that's figuring out a way to save money and decrease their expenses while increasing their revenue at the same time, that's really good. How often are you going to see that? Not too often. If the company is growing and doing certain things it's supposed to be doing, okay? So let's just look and see what we see here. So we see total operating expenses, $5.9 million, 2021, 2022, $45.9, 2023, $186, 2024, $130, 2025, $351, and 2012 months, $687. This is how much it's costing this business to run as a whole. Talking about paying employees, products, services, equipment, all that stuff. Okay? So by the time you subtract that, the gross profit from the total operating expenses, then you're going to get operating income. Okay? Which is basically the profit left from the gross profit after you subtract the total operating expenses. Does that make sense? Okay? This is the type of shit we should have been learning in school, y'all. Not A plus B squared. Not triangle X pi equals YZ. Not none of that loose ass shit. Talking about real education. Okay? This is real education here. This is not no bullshit that we've been taught in our school systems. Okay? So operating income. All right? You want to look at this same thing. Okay? Now, remember what I said, anything that's as far as income, we don't want to see negative. Okay? So what I'm seeing here is these guys are, by the time they pay off their, they spend money on the things that they need to run their business, they're negative after that. Okay, so because all we're doing is simple math here. You take 515 and you subtract that by 687. You're going to get negative 171 million. Okay? What killed them here? Their business operating expenses is too high. So instantly after that, your operating income is going to be negative. Okay? All right. So now, typically what you're going to see is these numbers after this. If the operating income is negative too as well, you're going to see the net income negative as well. Okay? So what we see here is, let's just look at 2024. If you look at 2024, see how they went negative 30 million for the operating income. Then they still had other income expenses, pre-tax income, okay, which they got taxed on, which came out to the net income common stock hold, you can call it, which came out to negative 28 million. So they were not in profit. Okay, so from 2021 to 2024, they were not in profit. Even though they made all this money in total revenue, by the time it came to their bottom line and net income, they were not in profit. They actually lost money. They actually lost basically 30 million, right? This year, 2023, they actually lost 171 million. When you see that negative, that's bad. You do not want to see that on a column like that, okay? So as of right now, 2025 and trailing 12 months, it's saying that this company is positive. But what they did was they took from the operating income and then their interest expenses. So they technically they were profitable, but they had to pay taxes. Okay? Most of the time, you're not going to see this, guys. Most of the time, you're not going to see the operating income negative and then the common stock hold positive. Okay? Most of the time, you're going to see it like this. So if you look at a company that's just horrible and just not profitable at all, like Snapchat, I'm pretty sure all of you guys are aware of Snapchat. If you go to Snapchat, look how right here the operating income is negative on all columns, right? But then you go to net income, common stock hold, this column, look how all these numbers is negative, right? Because they didn't have enough money. They instantly went in the hole after the operating income. So they didn't have enough money to take care of everything else. Okay? Pre-tax income, all of it was negative. Right? So you never want to see a bottom line negative. So this income statement is good. The top line is good, but this bottom line is a little wacky, in my opinion. Okay? They were negative up until 2024. Sometimes you could check quarterly to get a little bit more extra detail of what's going on. You could check the quarterly reports because, you know, companies have earnings every 3 months. So you could check that from, like, let's just say last year, 2025. Let's just see if these guys were positive at all. For the first quarter of 2025, negative 51, negative 21, negative 16. They were knocking it down. And then this quarter, fourth quarter of 2025, they actually came out positive. Plus positive was their first positive quarter of last year of 176 million. Okay. Q2 of 2026 was positive. Q1, I'm sorry, and then Q2 was negative. So their bottom line is not the best. All right. Let's continue to go forward. All right, profit margins. Okay, instantly I'm looking at these and I could tell that they suck. Okay, so this is one of my main metrics here. This is very important here. And I'm going to explain to you guys why profit margins can honestly be more important than actually the net income, the actual number. Because institutions like to use profit margins as a metric to compare companies when they're coming down to their full final decisions. So, like we spoke on earlier, every company is a part of a sector in the industry, correct? So, these institutional investors want to pick the best companies in this specific sector or industry. Now, if you have a company that's in the same sector or industry, how do you know which one is the best one if they do the same thing? How do you know that? And if they both positive, if they both got positive numbers or negative numbers, how do you know which one is the best one? Margins and ratios. That's how you know. Look at it just like this. All right. Let's just say you got Quan and you got DJ. Matter of fact, I'm going to pick two people on the live. Who on the live right now? You got 650. My nigga who was rushing me, he learning now. And then you got Paid Rashawn for sure. So you got my nigga Rashawn and 650. All right, bet. So let's just say Rashawn got hustle in him and 650 got hustle in him. So I give 650 and Rashawn both $100, right? And it's 2025. And I say, bro, by the end of 2025, early 2026, I need y'all to bring me some money back. But I want this money to be more than what I gave you, okay? This is what profit margins is. Just stay with me, right? Both of them got hustle in him. I done seen what they did in the past, right? They this, that, and the third. They know how to get shit off. All right, cool. I'm going to say, bro, I'm about to give you a loan. I'm going to give Rashawn and 650 both $100, right? Boom. By the end of 2026, Rashawn come back with 200. Meaning what? He didn't double what I gave him. Right? 100%. He got 100% return on my $100. So I gave him 100, but he brought me back 200. So that means he gave me a 100% return. Cool. Now I can break him off $50 for going to go do that for me. And now I'm up 150. Make sense? All right. So his profit margin was 100%. Or his gross margin, however you want to say it. It's just his margin was 100%. He gave me 100% return on my money. Because I gave him $100, but he brought me back 200. So, but he gave me enough to break him off 50, and then boom, I keep 150. You feel me? Now let's say 650 bring me back 400. So bro just made a 300% return. I gave him $100 and he brought me back 400. Meaning he just made an extra 300 from my 100. He just got off. He got way more hustle than Rashawn. I'm finna put my faith in bro to get my return on my pay. Even though Rashawn gave me 100%, I respect that. I fuck with that. All right, cool, for sure. At least you ain't bring me back negative. At least it wasn't on no shit where it's like I gave you 100 and then you fucked the bread up and you only gave me $50 back. Like, damn, you lost 50% of my bread. You feel me? He ain't do nothing like that. But the fact that 650 brought me back 400 out of this 100, nigga gave me a 300%, 400% return. I'm fucking with, I put my faith in bro. He got way more hustle than, even though these niggas do the same shit, he was able to get off way more than bro. So I'm gonna fuck with him. So if you look at it like this on the back end, that's what this shit is telling you. The profit margins. Yeah, bro, profitable, but by how much? Because if it's the same company, right? And they got the same industry and sector, but both of these niggas is positive. All right, cool. Both of these niggas made money. But who made the most money? Who was able to get a better, greater percentage out of their shit? That's what the one you're going to mess with more. Do that make sense? That's how you could tell a company, like the difference between a company that's in the same sector and industry. Okay? Do that make sense? So when you look at margins and they're shitty margins, you really want to stay away from that company or figure out why those margins are that shitty. And then you're going to be able to go to another company, a sector in that industry, and if they got better profit margins and ratios, you will go with that company more. Okay? Why do you think companies love NVIDIA over AMD? Because NVIDIA's profit margins are just through the fucking roof. AMD cannot fuck with NVIDIA. Think about it, bro. So if you got two people that do the same thing, but bro got way more hustle, I'm more likely to give my money to bro to give me that return. You feel me? He said, "My fault for rushing you, gang. You doing God's work. You all good, my you all good, my nigga. I just be trolling, bro. But for sure, gang. I'm glad you learning, man. I have an interest in this shit, bro. 1,000. We all straight, bro. All right. So as I see right now, man. Okay. So the gross margins is always gonna be your difference between that revenue. Okay. That's about how much of which the revenue is growing from its cost of revenue. Okay, gross margin, profit, operating margins. That's your difference between your operating income and your operating expenses, and then your profit margins. That's the difference between your total revenue and your net income. Okay, you do not want to see these numbers negative at all. Typically, you are going to see these numbers negative if you're going to see those percentages negative if the net income is negative too, right? Because this is just telling you by how much did they lose money? What percentage of by how much did they lose money? Or what percentage of how much did they grow their money? Make sense? So off the rip, I can tell that the gross margins are really good. They're maintaining about a 50% or so, 50 to 60% or so gross profit, gross margin. So that's really good. Operating margin is killing them. Their operating margin sucks, which we can see the numbers correlate here. Look at the operating income. Look at the negatives. Buy them, right? Look how low these are. They're actually losing money, right? So that's going to correlate to right here where you see the operating margins. That's why this look like this. So that's horrible. Okay? And then profit margins aren't the best either. How the fuck you lose 700% of your money in 2021? Damn. You was in a whole 700%? 2022, you was in a whole 700% again. 2023, you was in a whole 227%. 2024, you was in a whole 15%. Like, margins is horrible. Y'all just now being able to get on y'all toes. Okay? After you go look at the margins, what you want to do now is compare it to a sector and industry. All right, both sectors and industry. What you're looking for is either for those margins to be either greater than, to be either equal to or greater than the profit margin expectation of this sector and industry. So let's just look at trailing 12 months. It say that trailing 12 months, their profit margin is 50%. They could just be having a good year so far. Last year, their profit margin was 17%, but before that, they was in the hole horrible. So let's try to get an average of they were negative. So really, their profit margins aren't consistent enough for us to really get a really good estimate of average of what their profit margin is, because it's all over the place, right? So if you look at a company, right, an amazing company like, for example, NVIDIA, you're not going to see that at all. You're going to see a lot of consistency here. So let's pull this up. I want you guys to see this, okay? You see right here where it says profit margin? Look how clean that look. Y'all see that? Do I need to zoom up a little bit? Look how clean that look. Y'all see that? Look how clean these NVIDIA profit margins look. In 2022, their profit margin was 36%. 2023, 16%. And then 2024, 48%, 2025, 55%, and then trailing 12 months, 55%. Okay? So they've been averaging 50% plus for the last 2 years. All right, which is really good. 2-3 years. Before that, they was at a 16 and 36. So we could say about a 20. So on average, their profit margin for the last 5 years has been, we'll say, about a 30 plus. Okay, but for the last 2-3 years, they've been averaging 50%, which is really good. You see how the numbers aren't all over the place, though? You can kind of get a feel for what's going on. That's what you want to see. When you ever look at certain things and it look like it's way too much all over the place, then it probably is. All right. So their profit margins are not the best. Okay, so it's hard to get real average out of this. So we could say their average, because they was negative all these years. So we just got to imagine that this was break even. Account for these 2 years of inconsistency, how you go from 17 to 51. So I would say about a 10% profit margin. Like, it's not even really too much that we could work with. So let's just see what their expectations is for the sector and industry. What you do on stockanalysis.com, go to industry, click on capital, click on the industry, and then it's going to show you all the stocks that's in the same industry that does exactly what this same specific company does. Okay? Or a general aspect of it. So their profit margin expectation for this industry is 8.7%. That's just what this industry is expected to do. Not saying that they can't do more or less. This is just the expectation of that industry. Makes sense? 8% profit margin. We just said on Iran, it was hard for us to really get an average because those 4 years we seen was negative, and then the most recent 2, it was at 17 and then 51. It's kind of all over the place. So if we just talking the 12 months, yeah, they're doing good. They're blowing this out the water because they're at 50%. And then obviously last year too, they was at 17%. But we do got to accommodate for the last 4 years that their profit margins was horrible. So I would say, honestly, they're probably just about average. Because they are looking like they were trying to come back. But the last 4 years, since like 2020, we seen was they were in the hole, their profit margin. So there's no consistency there. So we will say that they're just now starting to get equal up to their specific industry. Also, I like to look at which number do they rank in this list of 90 of their industry. Okay, so let's look for Iran real quick, and let's see what number do they rank out of all these 90 stocks in this specific industry market cap wise. And that's going to give you a good brief summarization of the company too as well. Typically, your companies that's like in the top 20 of your sector industry is going to be your best companies that does what they do. So let's just see where Iran is. See where this company is real quick. $11. Okay, that's not bad. We said the first 10 or 20. So they rank 11 out of 90 stocks in this industry. Perfect. All right. Now let's go check this financial sector, which is 18%. So we already know instantly off the rip, they're well over below their profit margin expectation of their sector. It's 18%. We said they was like an average of like that 8% and under, honestly. So this one has 1,042 stocks in it. So I'm assuming that market cap wise, these guys are going to be well like in the hundreds or something. Yeah, they're definitely not in the top 20 market cap wise. Yeah. It's probably going to take us a while to find that. All right. So I'll give that income statement about a 5 out of 10. Probably even like a 4. But the revenue is really good. The profit, like, I'll give it a 5 out of 10 so far. All right. That's just one statement we broke down. We're not even halfway done yet of breaking this company down, y'all. All right. Balance sheet. Let's get it. Y'all learning? Let me know. Let me know y'all learning, man. All right, bet. Let's get to it. So, balance sheet is important because this tells you exactly what it is. It's a company balance. Okay? How well balanced is the company? This shows the strength of the company. This is the backbone of the company. Okay? This tells you the difference between how well this company manages its liabilities and its assets. Okay? That is what the balance sheet is. This is between a company's assets and liabilities. Does that make sense? Everybody on the live know what liabilities are and assets are. I'm pretty sure you heard of them before. Assets, like Robert Kiyosaki say, is simply something that puts money into your pocket. A liability is something that takes money out of your pocket. Okay? The balance sheet is going to tell us whether a company has more liabilities or either more assets. And then which percentage difference, which is going to be the equity gross, the difference between those assets and liabilities. All right? So, on the balance sheet, you're looking for everything to be balanced. Typically, you're not going to see nothing too crazy out of whack. You shouldn't. Everything should be structured really well on the company's balance sheet. If it's not, that's a red flag. All right? I'm looking for the same thing here. Either year-over-year growth or growth just in the last 5+ years. Okay? For everything top line and bottom line that it needs to be. So, you go into this column right here. Total assets right here. And then we're going to compare that with their total liabilities. Okay? I'm looking here first. Does this company has more assets than liabilities? Okay? First, we need to see, is their assets growing year over year or just in the last 5 years? Are they negative, right? What do we see here? So in 2021, their total assets was $134 million. 2022, $570. 2023, they flopped, $332 million. They went from $570 million to $332 million. 2024, they got it back with $1.1 billion. They was able to get up in them billions. All right, cool, of their assets being worth $1.1 billion. 2025, 2.9. Okay, cool. They went crazy. That's a nice jump. Trailing 12 months, they're at $7 billion now. All right, the last two. All right, basically like year to date, trailing 12 months, they're at $7 billion, which is really good. They went from 2.9 to $7 billion in total assets. Perfect. Now we want to check these liabilities. Okay. Very simple. You're looking for the liabilities, right? Because this is something that's taking money out of the company's pocket. So any column like that, you're looking to see decrease. But like I said, excuse me, you're not going to see that a lot of the times. The company is growing at a decent rate. You are going to see those expense columns increase as well. All right, but it just has to make sense. So, 2021, 183, 2022, 133. They was able to decrease their liabilities, which is really good. 2023, 26. Wow, 26 million from 133, which is really good. 2024, they brought it back up a little bit to 55.3 million. 2025, they brought it back up to 1.1 billion in liabilities. Wow. And then trailing 12 months, they're set currently right now 4.5. All right. So all over the place again. That's what I'm hating about this company so far, is that certain columns are just all over the place. I just don't like to see that. Like, it's really weird. But it looked like they were trying. They were doing good until they got to about 2024. Their liabilities went up from 26 million to 55, and then all the way from 55 to now 4.5. But now we got to look at this bottom line, okay? Shareholders' equity. All right. Right here, shareholders' equity, or on Yahoo Finance, you will see it'll say equity common stockholder, something like that. All right. But the equity, Okay, it's going to be your positive difference between, where it should be positive, the difference between the assets and liabilities. So that's what this is. Okay. So in 2021, they had total assets of $134 million of assets, but they had $183 million in liabilities. So they were negative. Their shareholders' equity was negative, basically $50 million. Make sense? So at that point, this company had way more liabilities than assets. Make sense? So you want to see these columns positive, and you want to see them be a nice difference, like surplus in between. Okay? You never want to see that spread too close. As much as possible. All right? So shareholders' equity was $437. That's because they had $570 in total assets. So they did really good with 2022. 2023, their total equity went down to $305 million. And that's because total assets was still positive, but it went down a little bit. It was still positive though. 2024, they had shareholders' equity of $1 billion. They finally touched that 1 billion mark, which was really good because they had total assets of 1.1. They had total liabilities of 55 million. That brought them to that total of almost 1.1 billion. 2025, they had a surplus difference of 1.8, which is really good because they had 2.9 in assets, and liabilities they had 1.1. So that's not too bad at all. And then 12 months, 2.5 billion. So honestly, their balance sheet is good. Their balance sheet is decent. I think I would say I like the balance sheet, honestly, more than I like that income statement. If I'm being all the way 1,000. Everything came out positive. And everything is growing year over year. The only one that didn't was obviously 2023. But this is still a lot. They still was able to surplus $305 million. But they haven't been in the hole since 2021 on their balance sheet. So that's really good. All right. Now, this is important that you want to look at. Okay. Cash to debt ratio. You always want to understand how much money does the company have compared to my fault, I was just looking at something. Compared to its debt. So typically for a company, as far as like financial strength, you want to see a company have more cash than debt. Okay, that's going to show some really good financial strength. Now, when it says total debt, all that's doing is taking its short-term debt and long-term debt and combining it together. Anything that's short-term debt is any debt accumulated within the last year. Any long-term debt that's considered long-term debt is any debt that's accumulated with anything more than a year prior. Okay? So now you have to look at it like this. If this company was to pay off all of its debt all in one right now today, how much money will it have left over? And if the company still has money left over after potentially paying off all of their debt that they are in, that company is considered financially strong. Okay? Now, if you have a company that was potentially take all of their cash and cash equivalents and pay down their debt, if they are still in debt, if they was to do that, then that's a sign of weakness. Okay? Now, obviously, it's going to depend on how much, right? Because if it's just slightly negative or slightly, right? But you don't want to see a company only got $20 million in cash and cash equivalents, but $50 billion in debt. That means that is really horrible. That means at any point in time, that company is willing to go bankrupt because y'all owe too much money. Y'all don't have enough cash on the side to be able to take care of that. Not even half of that. Does that make sense? It's just like this, bro. Look at it just like this. All right? Let's just say you make $2,000 a month. Okay? You make $2,000 a month, bro. Your rent is $1,000. Your car note is $1,000. Your car note itself is $1,000. Okay? Groceries a month is costing you $500. Gas and car insurance is $250 each for the month. So that's another $500. And then you want to have some fun. You want to spend some money on yourself. So that's another $1,000 for the month. So altogether, that's $4,000. But you only made $2,000 for the month. So your cash to debt ratio would be negative $2,000. So you couldn't even pay off all of these things and spend money on all of these things and still have money left over. You got to go in the hole to do all of that. You got to go negative $2,000 to do all of that. Do that make sense? You got too much weight on your shoulders. You got too much shit going on. Do that make sense? You could look at it just like this. If you got $2,000 put up right now, right? But let's just say you owe a credit card. You owe a credit card. You got a balance of $4,000. You can't pay that full $4,000 to make that balance go to back break even. You can only afford to put $2,000 on this shit. You still going to be negative $2,000. That makes sense? So this is a metric that I like to use. I don't like to stay away from companies that got too much debt on their balance sheet compared to their cash. Because if something really catastrophic fucking happens, or you guys make one wrong investment, one bad move, y'all effed over. You don't have enough cash reserves sitting on the side to take care of all this damn debt you've accumulated. So how do you identify this, Chris? I get what you're saying. All right, I get it. I understand it now. But like, how I know how much debt the company got? How I know how much cash on the side that they got if they was to pay it off and certain things? Like, how I know this shit, bro? I'm about to show you right now. So what you want to look at, what you're going to see on the balance sheet, you're going to see something called cash and cash equivalents. Okay, you're also going to see something called cash and short-term investments. Okay? Pretty much you're taking this number here. It could be either one. Most of the time they're going to be the same like you see here. Cash and cash equivalents and cash and short-term investments. Either one is going to be the same most of the time. Right? What you're going to do, you're going to take this number here, the cash and cash equivalents, this column. Pay attention, y'all. Real shit. Okay? You're going to take this number here, and all you're going to do is subtract it by its total debt. Not the short-term debt, not the long-term debt. Remember, the total debt is your short-term and long-term debt combined together. So you take the cash and cash equivalents and you subtract that by whatever that total debt is for that year. Then that's when you're going to get net cash or net debt. Net cash, obviously, if it's going to come out negative, that means that this company is in debt. If it comes out positive, that means that company still will have cash left over if they was to pay off all of their debt. Does that make sense? Okay? So let's look real quick. Let's look at this shit. So if you go right here to cash and cash equivalents, they had a cash pile sitting on the side of 38 on their balance sheet, $38 million. Okay, in 2021. They had total debt of $180 million. So who's here good at simple math? Because if you are, you will get negative $141 million. You take 38 million and you subtract that by $180 million, you're going to get negative $141 million. Did that make sense? So that means this company in 2021 was in debt $141 million. In 2022, they were actually positive 1.6. Why? Because if you scroll up, they had cash and cash equivalents of 109 million. You subtract 109 million by 108, you're going to get a net of 1.6. So they actually had 1.6 net cash, meaning if they was to pay off all that $108 million in debt right now today, guess what? They still gonna have $1.6 million left over after that shit, bro. Make sense? Net debt or net cash, okay, for 2023 was 67.4 million. That was really good. Okay? They had a lot of money left over still. They had more cash than debt. Perfect. 2024, this was good. They actually did really good 2024. They only had $1.3 million in total debt in 2024. Holy. And they had a cash pile of $404 million. Wow. That was extremely good. That was insane, honestly. And then 2025, here's where they lost all of that. Look at the irony in that, bro. That is insane, bro. What? This is what I'm talking about. Y'all see where I'm getting like frustrated with this company? Because every time we find something good about it, we instantly see some shit that's like throw us off. That's what's been happening. You had a net cash 2024 of 403 million. Then 2025, you were actually in the whole net cash, which means this is debt. You actually owed this. How did you owe for? What did you do? What did you do? You literally just lost everything that you just kept 2024. You lost that in 2025 to the T. You had a net cash positive of 400 million 2024. In 2025, you had a net cash negative of 400 million. How do you do that? Y'all see where I'm coming from? These are the red flags that you need to be able to identify and notice. Like, the balance sheet we said is supposed to be balanced. Shit is supposed to make sense. This don't make sense. All over the place. You had a net cash was really good of 564 million, but you just accumulated hella debt in a short amount of time frame of almost $1 billion. Then you did the same, y'all doing the same shit trailing 12 months. So I gotta give this balance sheet another 5 out of 10. I cannot give this. This is not what you want to see on the balance sheet. Okay? Numbers are all over the place. Y'all was doing good from 2022 up to 2024. You just gave it all up. All right? So that's another 5 out of 10. I'm going to also show you guys, when I'm done with this, a website that I use to validate everything that I'm going on here. It's called Guru Focus. I'm going to show you guys how to use that and my sauce, or what I like to look for as far as analysts, giving me the same type of, they're either going to agree with my analysis or not. But they have it already fully. And all you do is, I look at what I need to look at first, and then I go to Guru Focus, and it's literally going to tell me, hey, this is the percentage out of 10 of certain things, right? So y'all gonna catch on to that. Y'all gonna see how all this shit pieces together, bro. How you find really good investments, good stocks to trade. Okay? This is real game. Yes, Guru Focus, bro. All right. So now I'm on the cash flow statement. Okay? So the cash flow statement, guys, is the money left. It's your cash flow, okay? So typically you would take the net income, and then you would pretty much go from there. Now what you're looking for here is 2 columns. It's going to be your capital expenditures and then free cash flow, okay? So you're going to see something that says capital expenditures, meaning what is spent from that operating cash flow. Okay? And then you're going to see you're going to see free cash flow. Okay? So, what we take here is, I'm going to show y'all this real quick. What you do is, hold on, I'm looking for the column. Where is it? Here it is. Capital expenditures. Okay? This is the main one you guys need to look at. All right? It's going to be under operating cash flow. Okay? So, essentially, what you're doing here is you're looking to see, are these guys on their cash flow statement increasing their income or decreasing their income? And then by, is it year-over-year growth or year-over-year decline? Are the numbers positive or negative? Okay? Well, I'm sorry, they're always going to be negative because it's expenses. It's dealing with expenses. Okay? So you're automatically going to, this means capital, this just means that they spent this. Okay? Make sense? So that means that they spent this. So capital expenditures, their income or their expenses are increasing. It went from 2021 all the way from 81 million to now 1.8 billion. 12 months of 2026. You go to the free cash flow statement, okay? And that's where you're going to see the bottom line. We're almost done. We're like halfway done, y'all. I'm breaking this company down, okay? You want to see this column positive, okay? This is very important. So off the rip, Iran is negative, okay? Every single year from 2021 to till now, they cannot keep their free cash flow statement positive. All right? So what that tells me is that this company has no cushion. Look at free cash flow just like this, y'all. Free cash flow is very important. Free cash flow is money that you got put up in a safe somewhere that you don't got invested. You don't got tied to no bills. You don't got tied to no expenses. You don't got to do shit with this money. This money is literally free money. Extra money that you got put up to the side. You don't got this money dedicated towards nothing. You just got a big ass cushion. Okay? So what this is telling me is that Iran has what? Not Iran, ticker symbol, has no cushion at all. It is easy for a company like this to go bankrupt. It is easy for a company like this to end up in too much debt like we've seen already. It's easy for this company to have financial problems because they have no extra cash on the side, let alone net cash on that damn balance sheet. It is hard for a company to go bankrupt that has free cash flow. That has a lot of free cash flow. And what I'm seeing here, y'all, is year over year, this shit is growing. This shit's not even decreasing. So 2021, they had 80 million, negative 80 million free cash flow. It was actually negative. They lost 80 million on their cash flow statement. 2022, they lost 330 million. 2023, they lost 110. It was in the hole, 110 million. 2024, they were in the hole, 427 million free cash flow. 2025, negative 1.1 billion. You see how it's growing? Even till now, turning 12 months, damn near $1.4 billion. Negative. They had no cushion, let alone that balance sheet. Do you guys want to know what that's supposed to look like? Do you want to know what that's supposed to honestly look like? What you're supposed to see there? This is what you're supposed to see, bruh. Look at that. Look at Apple. Look at that difference. These guys are maintaining $100 billion. I don't think y'all understand the significant. This is, bro. This company has $100 billion plus sitting on the side cash. They've been doing this for years. Free cash flow. 2021, $92.9 billion. 2022, $111.4 billion. 2023, $99.5 billion. 2024, $108.8 billion. 2025, $98.7. 2012 months right now, today, $123.3 billion of free money just sitting on the side, not tied to shit. Think about that. So you ask yourself, how the hell can a company go bankrupt that got over damn near $125 billion, not million, you guys? Do you know how much a billion is? Do you understand how much a million is? Do you understand how much a billion is? We're talking about $123.3 billion with a B of free ass money just sitting on the side, not tied to shit. So that means these guys can handle. The world can blow up tomorrow. Apple gonna be straight. Nigga, a bomb can hit this bitch tomorrow, bro. A nuclear bomb can hit this motherfucker tomorrow. Apple gonna be straight. Before these niggas go bankrupt and have to ask another motherfucker for another dollar, they got $123 billion sitting in a fucking safe somewhere. Do that make sense? That is what gives you belief in your company. That is what gives you validation. Oh, this company is really financially strong. It's hard for a company to go bankrupt with $100 fucking billion plus dollars sitting in free fucking money. That's not even counting all the other shit that they got, y'all. Do that make sense? This is how we're not gambling when we're picking these stocks and these investments. We can see the data. We can see the back end of all this shit. Of our investments. We're not going based off of the news saying buy this, that, and the third. No. We got to go look at this shit and see actually what's going on. It's important for you to know this. Yeah, the charts are cool, but the charts just tell you where you should potentially buy or sell your stock. But that's not telling you if you should even buy it or sell it or not in the first place. What's telling you that is the fundamentals, y'all, what we've been going over the whole damn live the whole time. And which I'm really good at. This is what I preach in my group. This is the sauce. This is the bread and butter. All that other shit come after this. Do that make sense? So far as Iran, we don't want to see that. Okay? We're almost done. This is the real, y'all are seeing the real routine of me, how I break down the company, bro. It takes me about it's only because I'm explaining everything on the live. It really takes me about 30 to 40 minutes to break down a company. And even then, probably longer than that, depending on how deep down, like, diving I want to do into the company. Because you do got to do It's a routine, right? But it's a thing where the more you do it, the easier it get. You feel me? Like the more and that's with anything in life, you know. So when you first start learning how to break down a company, yeah, it's probably gonna take you 2 hours to break down one full company. And by the time you done breaking down one company in them 2 hours, bro, I done already broke down 6 stocks to the T and know already if they profitable, know the company in and out, know the red flags of it, all type of shit. I done broke down 6 companies while you still on one. But the thing is, the more you keep doing it, you're going to get to the point where I'm at within 2 hours. You have been able to break down 6 companies within 2 hours to the T. Like, not no little shit either. I'm talking about looking at everything. You feel me? So, you know, it just comes with time. All right? And I make this shit really simple, man. It's really, really simple shit, bro. Now, you want to look at ratios, okay? So, ratios is very similar, going to be to, very similar to the profit margins we talked about, which we looked at, okay? We looked at a lot of profit margins, okay? So, like I said, the profit margins and ratios are, and make sure you guys DM me the word invest, okay? So you guys can get full access to everything and learn this stuff in and out, all right? To know what you're doing, know how to navigate the market. Everybody else on the live right now, just DM me the word invest, all right? So we can lock in. So you can continue to get this game as you're going in your journey, not on your own, all right? So pretty simple here. We're just going to look at these 4 columns real quick, and you're just going to look at the margins, all right? Do you study how to research them in your academy? Yes, 1,000%, my brother. So that's what this is, bro. The routine that your guys are seeing me go over, that's what I teach in the actual community, bro, to the T. Okay, so it's right here. Everything, this is actually built in the community, by the way. This is not separate. So everything that we going over right now, guess what? This whole full section covers it to the T. 25-minute videos, 30-minute videos, 15-minute videos, everything in full detail, right? The apps, websites, everything that I use to be able to identify all this stuff. So I actually teach my group how to eat. I'm not the nigga that just give people signals and shit like that and stock picks and not teaching them how to actually go fish for themselves and how to really do this shit. You feel me? Like, no, I want to do it with you. I want you to know how to fish for yourself, but also, hey, let's eat together. You feel me? So that's why the sauce is actually built in my community. It's not separate. Yeah, you could get the quarter separate if you want to, but if you want everything all in one, it's there for you too as well. A lot of programs, you cannot do that. A lot of niggas want y'all to just pay for hella extra different shit for no reason, bro. All right, so boom, this is where we at. Okay, so let's read this. The reason why I like stockanalysis.com too is because if you're not like familiar with something, if you need an extra something broken down for you, whatever the case, it'll do that for you. So you can hover over this, like look at return on equity. And I just want to know, what is return on equity? Well, all I have to do is what's today's date? Okay. All right, cool. I gotta handle that. So return on equity is a profitability metric that shows how efficient a company is at using its equity's net assets as to generate its profits. Okay. Return on assets. Return on assets is a metric that measures how much profit a company is able to generate using its assets. Okay. Return on invested capital. Return on invested capital, ROIC, measures how effective a company is at investing its capital in order to increase profits. This stuff is really important, y'all. This is the last one. ROCE is a financial ratio that measures a company's profitability and efficiency at deploying its capital. Okay. The higher the value, the more effective a company is at generating profits from the capital it invests. Oh my God, that's so important. Do y'all understand that? Do you understand the importance of that? So instantly I can tell, bro, that's just telling you that this company is not good at none of that shit. Oh my fucking gosh, bro. Like, do I gotta zoom up on this shit, bro? Look at those numbers. If we are just saying, look, like, let's read this real quick. Let's read this again. Look at the negatives by it. Look how low the numbers are, and then but look at how basically every metric here, every percentage has a negative sign, but we just said that negatives are not good. When it's something that's dealing with the top line or bottom line, you don't want to see that. At the bare minimum, this shit is supposed to be positive 4%, not negative 4% at the bare fucking minimum. But you mean to tell me you guys are actually losing on the investments that you're losing more money than what you're putting in every aspect of what you're doing. Right? So look at this column. This column says return on assets. It's a metric that measures how much profit a company is able to generate using its assets. So that means that most of these niggas' assets that they think are assets are actually getting them in the whole negative. They're not even making any profit off of the shit. Their assets are producing them negative 33% in 2023. In 2024, their assets were producing them negative 4%. In 2025, their assets were producing them negative 0.4%. They not getting shit from, come on, y'all. Catch up with me. Catch up with me. Y'all gotta, come on, you gotta peep game here. Think about it. If this is return on ROIC, this shit says a financial ratio that measures a company's profitability and efficiency at deploying its capital. The higher the value, the more effective a company is at generating profits from its capital it invests. So this specifically is telling me that these niggas suck. That's like a nigga. Everybody, we all got a friend right now that think this nigga is good at trapping a bag. But this nigga really shitty at numbers. He the type of nigga to buy his bags for 100, right? Each bag costs 100 for him to buy. He bought 10 bags, so he spent 1,000. But on purposely, this nigga sell his bags for $50. So for each bag, this nigga is losing 50% that he is getting off. Do that make sense? This nigga think he trapped in a bag. Whole time this nigga is hustling backwards like a motherfucker. How the fuck you selling each bag for 50 when you cop each bag for 100, gang? And you selling each bag, you spent 1,000. So your net profit, nigga, you negative $500, gang. Cause you just sold, you had 10 bags, my nigga. You bought 10 bags for 100 each, meaning you spent 1,000 altogether. Then you finna go shoot cross town. You finna go shoot cross state. You finna take them bitches out west and sell each bag for $50. My nigga, I'm not putting faith in you, my nigga. If I ever hit rock bottom and I gotta trap a bag, gang, you was not the nigga for me to call, bruh. You gon' fuck our whole shit up, bruh. Real life, gang. You purposely giving niggas discounts. Like, what you on, my nigga? So when you guys see that, stay away from a company that looks like this, bro. This is horrible. That means that their assets are literally not even really assets, bro. You can't do shit with them. And that explains why the income, the balance sheet looks like this. Remember we said that shit is all over the place and we couldn't really find any balance. It's a balance sheet. This shit's supposed to make sense. This doesn't make sense, right? So that's what the ratios are for. It's telling you how good is management good at managing the company. This is management. Management is shitty, bro. You can't trust these niggas to trap the bag, bro. Shit looks horrible. You want to know what these ratios are supposed to look like? You want to know what good management team looks like on a company? You want to know what that looks like? It's supposed to make sense, man. Look at this. Nvidia is a motherfucker that I would trust trapping the bag, bro. Look at the difference. Oh my gosh, is we cooking here or not, man? What the fuck? Oh, look at that shit. Look at that compared to the other company we just looked at. Come on now. Look at these margins. Beautiful. Oh my gosh. Look at those percentages. Look at the ROIC column. 80%, 101%, 110%, 90%. So that means that everything that NVIDIA is putting his money into, these niggas is damn near getting a 90% return from this shit every time. Same thing with invested capital. Same thing with employee. Come on now. What is we talking about? But when you look at a company like this, they fumbling the bag, bro. They hustling backwards like a motherfucker, bro. If we hit rock bottom, I'm not putting my faith in this. I'm not putting my faith in, bro. Hell no. He gonna fuck the whole bag up. You feel me? Real life, man. Come on, bro. Who break this shit down like this, man? This is why my name Invest Your Bag, man. I really do this shit, gang. And I have fun with it, man. Real life. All right, cool. So now, what you want to do, okay? You want to go see what holders is holding your company, okay? You want to see what holders is holding your company, all right? Make sure y'all DM me the word invest, man. Let's get to it. No faking, all right? If you got $60, you can learn this shit, bro. Real life, okay? Because that's all it's going to cost you to get access to everything to learn this shit in and out, all right? So just put that investment up. You're going to get your return on investment, man. Like I said, this is what we should have been taught in school, bro. This is what I should have learned for the last man, I swear to God, y'all, I feel like everything that I use right now today, bro, I didn't learn in school, bro. Credit, building a business, content, investing, trading. Nothing that I use today, I didn't learn nothing of it in my damn school system. This is the real shit that we supposed to be learning, man. Not A plus B squared pi equals 3.968. Goddamn, you feel me? The shit they did to us in Black History and Christopher Columbus and all the bullshit that they bring up, bro. Teach me how to get to the bag, man. All right. So what you're looking here is you want to see, okay? Because we have to remember that the institutional investors, it is what it is. They're better than us. They know more shit than us. They got access to more data. They got inside knowledge, all type of things, right? So, with that being said, you can use this as a metric to follow the money, okay? Now, obviously, it's pros and cons to investing in a company that's heavily invested, that's already has a lot of major institutional weight in that company. Because obviously when they sell, you're going to see that stock take a dip too as well. But it is what it is. I would rather be on the winning side, right? That's why we trade options. So it don't matter if the stock is selling off and they got bearish momentum. Hey, and we in long term, keep our long term shares. We just finna play this motherfucker puts to the downside, right? Don't really matter. So with this being said, you're looking for your major top institutional holders that hold your company, okay? So that's going to be right here. So if I go to my profitable systems and strategies in the class here, you guys can see that right here, there's a list of stocks here. Not stocks, but, well, these are publicly traded companies too, but companies, majorly. Okay, so right here, you guys see these names? Some of you are already heard of these companies before. How many of you guys heard of them companies before already? How many of y'all heard of BlackRock? How many heard of y'all heard of JP Morgan and Chase? How many of y'all heard of Vanguard? How many of y'all heard of State Street, BlackRock, Goldman Sachs, Morgan Stanley, Berkshire Hathaway, Bank of America, Fidelity? How many of y'all heard of those institutions? Anybody in the live? If you didn't, well, you need to do your homework, because these are the institutions that control most of everything in the world. The real estate, the stocks, the commodities, insurance, everything. How many of you guys heard of them highlighted companies that I got highlighted right now? Let me know, man. Let me know. Bank of America, BlackRock, JP Morgan and Chase, Fidelity, Vanguard, Morgan Stanley, Berkshire Hathaway. Y'all heard of them? Let me know. All right. What you're looking for is for there to be at least, in the company that you're investing in, at least 2 of these major institutional holders. Okay? It's a few other ones that hold a lot of significant other weight, but these are like the main ones. All right? And the reason for that being is because you want to look at it like this, bro. Look at it just like this. Okay? If these major institutions is holding this company, then obviously they know something. Those major institutions are not putting BS companies in their shit. Now, obviously, right? They're going to have some BS companies in their portfolio just because they got the money to do that. These motherfuckers is worth hundreds of billions of dollars, damn near trillions. So they got some money to put in some BS money into some shit, right? But you're not going to see a significant amount of percentage or weight in that company if it's a horrible company. Does that make sense? So I'm gonna show y'all this. Okay. So IREN right now, as far as our list that we got, we said Goldman Sachs and then Morgan Stanley. Citigroup is another big one. That's really, really big one. I didn't put that on there though. But Citigroup is another big one. But as far as the list that we got is 2. So they do have 2 of the 8 or so major institutional holders that we like to hold the company. All right, cool. That's cool. But it's still not the top one. The top one is some other shit that we don't even know about, right? So off rip, that's telling me that this is probably some throwaway money for these companies. Not throwaway money, but like you got to peep game. Because let's go to a company like Nvidia, right? And I want you guys to see how much. Matter of fact, let's go back to Iran real quick. Y'all keeping up with me? All right. So look. I want y'all to see this, right? Look how Morgan Stanley got 7.7 million owns or controls 7.7 million shares of IREN. Goldman Sachs controls 7.3. Look at their total value of the company, which is their equity. Any gains, what they put in and any gains or losses inside of this specific investment. For Goldman Sachs, it's $357 million, which is nothing. Okay? To Goldman Sachs. Morgan Stanley, $357 million too as well, which is nothing to Morgan Stanley. All right? Believe it or not, that's nothing to these companies. I'm going to show you why. So they only have a 2% control or 2% hold in this company, IREN, that we've been breaking down the whole time. Now, I want you to see something. If you go to NVIDIA, right? Remember, we said they got, what, 357-something million weight in the company? Go to a company like this, like NVIDIA. Scroll to holders, and I want you guys to see something. Holy shit. Holy. We gonna take Morgan Stanley, right? Because we just seen Morgan Stanley on Iron. And they had a value of that company of what? 357 million? Now you can understand and see why when I say that is nothing. Because when you go to a company like Nvidia, what is their equity in this stock, y'all? 65 billion with a B. $65 billion. Nigga, that little 357 million that they got at Iran, that's throwaway cheese, bro. That ain't shit. When it's a company that they got value of $65 billion, the same institution, Morgan Stanley, we just seen. Okay? So even though, yeah, Iran has two of the major institutional holders that we like to see in our company, but we understand that they got throwaway cheese in that shit. In confluence with what we just seen with the financials, us breaking down those three major financial statements, every single one of them, the first two, which was the income statement and balance sheet, was a 5 out of 10, really a 4 out of 10, and then that damn cash flow statement was horrible, and then their ratios just threw us all off. So we don't really like the financials of that shit at all. Plus, in confluence with you don't got no major institutional holders with significant weight in this shit at all either. It's another reason why we don't like it long term. As far as the current state that it's in right now, I wouldn't touch it, right? Because if the institutions are going to believe in something, trust me, they're not going in light. If they in it, they in it. That's why you see Vanguard Group controls 10% of NVIDIA. Because they have a value of $455 billion equity in that company. They control 2.2 billion shares of it. Makes sense. Okay? So yeah, we like to see at least two of those major institutional holders in our company. But understand and look at the percentage and weight of which they have in it. That's going to tell you the more belief that they got in it. All right. Then you want to look and see whether the company is in the S&P 500 or not, in the NASDAQ or the Dow Jones or not. You want to see that. That's going to give you some confluence too as well. Okay. Now, after that, this is the last thing. This is what we like to use to validate everything that we just went over. All right. And it's going to be this website called Guru Focus. All right. This is what I like to use to validate my decisions and everything that I just broke down on my end. Are y'all ready for this? This is real sauce. You're not finna find this on YouTube, bro. You're not finna find this on no damn YouTube. None of that shit, bro. This is how you validate your investments. This is how you validate the companies that you breaking down, certain things of that nature, okay? You're going to go to this website. And I should not be giving you all this. Because I have people who invested in themselves in a full community mentorship to learn this same shit that we've been going over the live the whole time. So I'm really doing y'all a good service by this. And you can use this full blueprint of how to break down a company for every single stock that you ever break down fundamentally in life. You can literally use this live to navigate the whole shit. Obviously, we left some things out just because time's sake. But far as like pure beginner, you don't know nothing. You just need a blueprint on how to figure out if a company is good or not just off the rip. Bro, this shit is golden, bro. This whole live. You feel me? This is the last website. It's going to piece everything together. So, and I hope y'all tap in after this. I hope y'all don't finesse me, bro. I'm giving y'all all this free game. Letting y'all know how I'm coming. That I'm somebody that y'all can learn from. And really take this shit serious. And you feel me? Even if you don't, bro, it's all good. I still appreciate your support. But I want to see y'all fully lock in, man. To really get to the bag, bro. Y'all see what we doing, gang. The testimonial's there, bro. Like real life. You feel me? So look, Guru Focus. You go to gurufocus.com. Okay? And what you're going to do, type in your ticker symbol. So we've been charting IREN, ticker symbol IREN. Okay? You're going to click on that. It's going to take you to the stock. You're going to pull up the stock, right? Y'all can see that? And then what you're going to do, you're going to scroll down. Sorry, that was the wrong stock. Hold on, my fault. That was the wrong stock like a mother. Hold on. Here we go. That's what it should look like. That other shit was weird. This is what it should look like. Okay? Then you're going to scroll down. Bro, I'm so good at this shit, bro. I was accurate as fuck. Wow. What you're going to do, okay? You're going to scroll down. And then you're going to go to where you're going to look at three major things. Where it says financial strength, profitability rank, and then growth rank. Okay? Now, this is the analysis from analysis, right? From the people that work at these major institutions, and that's their job to break down these companies to the T and shit like that. That is who are giving you these summaries, the financial summaries of the company, bro. Meaning, even if you don't do everything that I just did to the T of breaking this shit down, you can just go here really quick and figure out if the company is profitable or not, or whether you should either be invested in the company or not. Oh my fucking gosh, bro. What the fuck? Did y'all just peep game? I just said, even if you didn't do none of the shit that we just did on the live, even if you don't even know how to do all the shit, nigga, you could just go on this website yourself and just literally just look at the, oh, come on, bro. They gonna tell you, oh my gosh, bro. Now, keep in mind, right? Before we ever pulled up this website, what did I say? I said, nigga, the financials statement was a 4 out of 10. Did I not say that? What did they rank this company? A 4 out of 10. Profitability rank. What did I say? I said that was a 4 to 5 out of 10 too as well. What did they rank it? For before I even pulled this, I promise y'all, I never looked at this. This was my first time charting this stock and researching this stock. I never pulled up Google Focus before I hopped on the live. None of that shit on this stock. But instantly, I'm telling you, I know how to do this shit, gang. So I'm ranking the company based off of me doing this shit myself automatically. I'm saying, this is a 4 out of 10. This is about a 5 out. I'm knowing. Right? Because I've been doing this shit for a little minute. So when I go to Google Focus, I'm just using this to validate my shit, the research that I done already did. Even though I don't really got to do no research on the front end, I could just go to here to this website and it's going to tell me instantly, automatically. We said their cash to debt ratio was shitty, right? We said that shit was ass. So now look, when you can actually click on the metric and it'll tell you their cash to debt ratio is worse than 68% out of 790 companies in the capital market industry. What the fuck? Come on, bro. This is real life shit. We said their gross margins and their net margins and their profit margins was shitty. This is telling me, this said ranked better than 56% out of 617%, out of 607 companies in the capital markets industry, but it's still horrible. Because if you go, you see that yellow shade, anything yellow shade and under is shitty. Right? It's telling you the metrics. Anything that you see green is good about the company. Okay? So that's what you're looking at next. That profitability rank. That's a 4 out of 10. Horrible. We already established that before we even looked at this. Right? And then you want to do another thing. Does the company has potential growth? So their growth rank is really good with a 9 out of 10. So they got room to improve. They just shitty right now. Make sense? But what you're looking for a really good established company, which I put right here in the class here, is you're looking for that on Guru Focus to be a financial strength, bare minimum of 5 or better, but really like a 6. And then profitability rank, we really want that profitability to be there, a 7 or better. This company has 4 out of 10 for both the profitability and financial strength, which is horrible. Already out the rip. So now I understand that this company, I just broke this company down. Okay? The company has growth potential, but where it's currently at right now and the shit that it's been doing hasn't been really consistent and good at all. So that's telling me I need to stay away from this company. Or if I do invest in this company, go in light. Okay? Because where it's at right now, it doesn't justify, the financials does not justify for this company being where it is trading is right now. It's at 48 per share. So this company is more so worth at least like under 30. Or it broke out of this chop from 2022 to July 2025. So if you could catch this thing at a start of like 30, is 27 is going to be really good. But currently where it is right now, I would not load the boat on this stock. So let me know if you guys, anybody stayed on the live the whole time. Did you learn certain specific details and things to identify about a company when it comes to a company financially? And how you can use that to not guess and not gamble in the market and figure out whether you should stay away from a company, figure out how much you should invest in a company, maybe not over leverage, go too heavy in it. Look at the chart and see where the value is on the chart and see where you can get it for a decent price. Comparing and contrasting the company to other companies and sectors that the company is in. Understanding what a balance sheet is supposed to look like. Understanding margins and ratios, certain things of that nature. Did you guys learn that? Please let me know. Because I was not on the live just teaching all these games for no reason, bro. I really want y'all to learn and take this shit serious, bro. And show you that it's not that hard. It's very simple, bro. You just need a blueprint. You just need somebody to be able to put this shit on the front line for you, my dog. That's it. We ain't do nothing hard. It just took us a little bit of time because we was explaining everything, right? But trust me, once you get in the game and you could be able to break down these companies in 30, 40 minutes, bro, and have a really good summary of the company. Okay? All right, cool. So I learned a lot, brother. And I'm a complete beginner for sure, my dog. I'm about to screenshot that. That's real, man. Appreciate it. Appreciate you staying on the whole time. So that's what I like to see, man. So you guys don't know, I do classes like this all the time on my repost page. It's plenty of game. Go learn. That's what my page is for. Keep y'all entertained, keep y'all laughing, keep y'all learning, keep y'all making money, man. All right, so go to my repost page. I do hella lives on my TV and everything. I'm gonna start doing them on the computer more. But go to my repost page and learn, man. I do charting, I do all type of stuff. Go to my YouTube. You looking for some mindset type of shit and just some things as far as like just mindset, life advice, all that type of stuff. That's on my YouTube. That's when I be on there kicking game. The TikTok is all funny shit on there right now, and then obviously my Instagram is everything all in one. Okay, and then if you're looking to take your trading or investing to the next level, you're just looking to get in the game. I do feel like I got the best beginner program, bro. Like I'm gonna be 1,000. Like it's everything all in one, bro. You don't gotta like if you want to learn trading, boom, it's there. Investing, long-term investing is there. Money management is there. Mindset is there. Memory communication there. Like everything there. Not saying that I don't want you to go try to learn sauce and this and outsource and learn, from everybody whatever you want to do, cool. But I'm just saying, gang, everything all in one for you, bro. My program is it. And I do stand on that, man. I feel like anybody that's in my community can vouch. Real life, bro. Especially if you appear as a beginner, don't know shit about the market, bro. It's there for you. So I appreciate y'all. Everybody learned, man. Hope y'all get into it. And let's continue to run up our bag, man. Invest your bag. Remember, invest in yourself. Believe in yourself. Keep going, man. I'm about to go ahead and end this. I gotta clean up and shit and just do shit that the rest of the shit that I gotta do today. Send this list through to my group. Finish breaking down these companies, and then yeah. So I'm about to get this full list of stock picks to my group in like the next by like 4 o'clock. And if you guys want access to that, what you could do too is subscribe to my Instagram. I give half of the picks that I give to my group, I give y'all half of them. So like, let's just say if I come out with 10 picks, I give y'all 5 of them just from being subscribed to the IG. You feel me? So little shit like that, man, y'all can benefit off of and just running up the bag. Also, pay attention to every month I come up with stocks, long-term picks that you guys could grab. If you pay attention, everything has been hitting, bro. Like if you watch them videos where I say, hey, if y'all got an extra $1,000 saved for the month, put it in this stock. Everything that I've been mentioning and been popping off. So the opportunity there, man. You follow my page to learn and get money. You feel me? So, and to stay entertained. So I appreciate y'all. Invest your bag. I'll probably hop on later. All right, one love. I'm out of here.